A report by rating firm Moody's shows that the Kenyan banking sector's outlook remains stable on steady economic conditions and solid financial buffers. But the firm warns that Kenya's bank's profitability may soften in 2026 from a peak in 2025, but will remain solid. Moody's pointing out that the shrink may come from non-performing loans, which continue to remain high. Jimmy Mbogo has more.
The latest Moody's rating of Kenya's banking industry has rated the sector at B3, representing a stable outlook. The rating agency notes that its decision is pegged on the steady macroeconomic condition, solid capital buffers, and gradual improvement of the sector's asset quality. According to Moody's, sector-wide non-performing loan ratio will decline towards 15% over the next 12 to 18 months from the 16.5% recorded in November. This, they say, will be supported by lower lending rates and accelerating credit growth, with private sector lending growth recovering. But despite the decline in NPL ratio, NPLs will remain high by global and regional standards, although banks' expanding regional footprint will continue to enhance revenue and risk diversification, with capitalization also expected to remain strong. Moody's further notes that profitability for Kenyan banks will soften in 2026, but will remain higher compared to other lenders in the region. They expect the return on asset to decline towards 3.3% over the outlook period as net interest margins narrow on lower government security yields. The outlook also argues that funding and liquidity conditions for Kenyan banks will remain stable, with deposits growth expected to remain on the upward trajectory. Jimmy Mbogo, Citizen TV, Nairobi.